Tighter risk selection, more disciplined underwriting, and moderating premium decreases in recent years have bolstered performance in the U.S. Directors and Officers Liability Insurance segment. Now, a new AM Best report indicates that competitive market conditions and an evolving liability risk landscape moving forward may constrain near-term profit margins. I'm Lori Chortis for AM Best TV, and we're joined today by the authors of that report, Associate Director David Blades and Senior Industry Analyst Christopher Graham. David and Chris, welcome. So great to see you both. Thanks so much for joining us.
Great to see you, Lori.
David, we should note that AM Best recently changed its outlook for this segment to stable from negative, but a fairly new variable in this discussion is the segment's results through the third quarter of 2025 and how that year may wrap up. What are the takeaways from those compared with a year ago and even past years?
Well, Lori, as you mentioned, we did just recently change our market segment outlook to stable from negative. And that's really was tied to the improving underwriting trends that we saw. And that's reflective, again, of the tighter risk selection that we see from the insurers in the marketplace. And so those favorable trends that we've seen coming forth and what we see actually continuing over the near term, we felt more comfortable also with the sort of change in the tenor and the degree of regulatory scrutiny. That's another factor. So we felt those factors contributed and supported a change to stable. In terms of our report looks at the results, actual results through the third quarter. And through the third quarter, we saw that premium trends, which have been trending downward because of the competitiveness in the marketplace. We saw the third quarter premiums and what they portended for the full year. We think we'll see when everything's aggregated for the full year, another year with premium goes down a little bit, direct premiums in the D&O liability marketplace, specifically for monoline D&O. But we think the decrease will be low to maybe low single digits percentage-wise. So again, we think the premium difference won't be that much. But what we're seeing from that standpoint is just the competitiveness in the marketplace. That's really the factor in terms of what we're seeing for the premium trends. And that competitiveness continues, even though carriers are recognizing, as we talk to our rated insurers, they are recognizing that there are evolving and emerging liability risks that are presenting some exposures for corporate officers and corporate directors. And so from that standpoint, we think even though we've seen the premiums going down a little bit, we think that those risks will have some impact in terms of constraining the profit margin going forward. And we do see that a little bit in terms of the direct loss ratio through the third quarter. It was 5 points higher than it was a year ago, or the full year loss ratio a year ago, but it's still several points better or several points lower than the loss ratio at the end of the most recent soft market, 2019, 2020, before rates spiked in recognition of the fact that the prolonged soft market had gotten the rates to a point where they needed to be fortified a little bit. So although we see the direct loss ratio has increased through the third quarter, and we think that's going to hold based on our early aggregations of full year data, we still think that the D&O marketplace is in a good position in terms of where loss ratios are. But because of those emerging and evolving liabilities, I think it's going to put some pressure on D&O underwriters to continue being, continue their conservative underwriting, continue to really look at the exposures on an account by account basis and make sure that they are, fully assessing the potential for liability risks that are facing their directors and their officers. And again, there are a lot of exposures, whether it's AI or whether it's, climate change, a lot of different exposures that corporate officers are facing now. And so that needs to be taken into account in the underwriting and in the pricing for these companies to continue generating the good results.
Well, speaking of pricing, what is the current pricing environment like for D&O liability?
Okay, so we've still seen on an account or on a renewal basis, account by account basis, from one year to the next, we've still seen that the market conditions are relatively soft. So we've seen low single digit discounts or decreases from the standpoint, particularly for medium and larger size risks. For the smaller risks, I think the insurers are doing a good job of kind of holding the line. And again, because of some of the emerging and evolving liability exposures, we do think that we'll see even more on some of the medium-sized accounts where we'll see maybe more modest decreases. And to the extent that those exposures are, that insurers look at those exposures and they feel like they need to get more fortification from a premium standpoint, we might see, a slight shift in terms of the market tightening up a little bit from a pricing standpoint. But right now, pricing trends have continued to be downward and continue to be soft on a renewal basis. And, we'll continue to look at that, through the year-end data. And really, it'll be interesting to see what 2026 brings, because like I said, we'll see if some of those downward rate trends hold. In previous years, IPOs had been down, SPACs, there had been fewer SPACs to deal with, also with security class action lawsuits, those have been down. So again, that's one of the reasons why, premiums had been down, because again, from a demand standpoint, there'd been less demand from that perspective. But we'll see if that continues to hold. And like I said, we surmise that profit margins are going to be constrained a little bit, again, because of the evolving liabilities that are facing corporate officers.
The report also discusses the role and impact of IPOs on this segment, and more specifically, the formation of special purpose acquisition companies. Chris, what are the developments in this area?
So we did see an increase last year, particularly at the end of the year, in IPOs and companies using SPACs to initiate those IPOs. That has accelerated in the early part of this year as well. We're only 10 weeks into the year, and the number of IPOs is already about a third of what the full year number was last year. And for SPACs, it's even greater. SPACs are making up 80% of the IPOs. So there's certainly a lot of activity. This is, it's not surprising. It goes, the stock market was up, there's a big deal that it hit 50,000. It's down since that over the past week, which is, a deeper discussion. But with that, companies have capital, and they look to use that capital, and, buying other, smaller companies is one, or private companies going public to raise capital. So it's, it's not surprising that we're seeing that.
And Chris, what are some of the key considerations that will be front and center for D&O liability insurers for the remainder of 2026?
Well, we'll stick with that topic for now, the SPACs and the IPOs. Anytime you see an increase in IPOs, there's always an increase in the transactional risk. To the point David made, when we weren't seeing those, there was less demand for coverage. Well, now you might see more coverage, and is it going to be adequately priced? What are the risks that come with that? Because when we had our the peak of IPOs, well, that was not too far off the peak of all the frequency of the security class action suits last time around. So there's reward in the premium for the extra. For the IPOs, there's also risk in that they bring, the transactional risk that comes with it. So that's a big concern for the insurers. There's much more cyber risk now that dovetails with the D&O coverage. When you get into things like what type of protections does a company have for being hacked, or data being stolen and exfiltrated and used down the road. Not having the proper protections can also lead to a D&O suit, in that there's reputational damage to the company. There's risk with AI. What exposures are out there when companies begin to use AI to replace human activity in some cases, or to expand upon what it can, what it's doing. What protections are in place? What happens if you have, AI or very large energy consumers? What happens if there's an energy shortage and your game plan is to use this AI for further research, develop whatever, and is the company properly protected against that? So there's a lot of risk in those areas as well for the insurers, that to make sure that the insureds have the proper protections or backups in place. You have there are some regulatory change, not so much changes, but focus. It's not that there's new laws, but there's new focus in place. Could be a change for what risk is out there for the insureds, and then of course that gets transferred to the insurers. So there's a lot of uncertainty out there right now in the D&O market in that sense.
Yeah. In addition to a couple of things that Chris was talking about from a regulatory standpoint, I think, like he said, I think with the new administration, the focus changed a little bit from the previous administration kind of championing DEI initiatives and ESG initiatives. Now with this current administration looking to get away from some of those initiatives, I think the focus or where the suits may come from are if there are reports that any of these companies are continuing to put forth and to have these proposals or these initiatives in place, that can actually get them in the crosshairs of the regulator. So I think it's a little bit of a change. So while we do think the regulatory scrutiny that maybe was there before is going to be at a different level, I just think the focus has changed. And so we'll see how that manifests itself with regards to suits that could be brought against corporate directors and officers.
David and Chris, always a pleasure. So great to see you both. Thank you so much for taking the time to speak with us today. Greatly appreciate it.
You're welcome, Lori.
Yeah, you're welcome. Thanks for having us.
That was David Blades, Associate Director, and Christopher Graham, Senior Industry Analyst at AM Best. You can view the full report online at ambest.com. For AM Best TV, I'm Lori Chortis.